All right, so you've been digging into some pretty interesting stuff this week. Stocks, Bitcoin, even what's happening with Walmart shoppers. Ready to do a deep dive with me and see what we can uncover?
Absolutely. Yeah, there's a lot to unpack this week. Got tech stocks potentially heating up, Bitcoin smashing records, and even some whispers that maybe the average consumer, well, they may not be doing as well as the headlines suggest. Let's see what it all means for you.
Yeah, let's jump right in. So that market snapshot, S&P 500 and NASDAQ are both up, but the Dow Jones, it's down just a bit, and gold is having like a little mini rally. But what's really interesting to me is that low-tech stock participation. What do you make of that?
Well, the low tech stock participation, that's definitely something to keep an eye on. I mean, could be a sign that there's still room to run in that sector, especially with, NVIDIA's earnings report
Yeah.
coming up soon. But it also makes you wonder, like, is everybody waiting for something?
Yeah.
Maybe just waiting for some clarity on where the economy's heading before they jump back into tech.
That's a great point. It's like everyone's just holding their breath a little bit. Speaking of things that make people nervous, Bitcoin. It's been on an absolute tear, up over 110% this year, and just blew past its old all-time high. What's driving this crazy surge?
Well, a couple things. We're seeing a lot more interest from institutions. Big players like BlackRock, they're launching Bitcoin ETFs,
Hmm.
and there's this frenzy of activity happening in the options market.
Oh, interesting.
Yeah. And what's really fascinating is, well, a lot of those options bets, they're all concentrated around Bitcoin hitting $96,000.
$96,000. Okay. I'm adding that to my watch list for sure. But does this all mean Bitcoin's headed for the moon? Or could this be a bubble that's about to burst?
Yeah, I mean, it's certainly possible, but we have to look beyond just the hype. Like, why are institutions suddenly so interested in Bitcoin? Is it because they see it as a hedge against inflation? Are they looking for portfolio diversification? Or is this just, FOMO, fear of missing out? Understanding their motivations, that's key to figuring out how sustainable this rally really is.
Okay, so Bitcoin's a bit of a mystery wrapped in an enigma, it seems, right now. Let's shift gears to something that's been worrying some investors: stagflation. People are looking at the bond market, especially the TLT ETF, which tracks those long-term treasury bonds for clues. What are they seeing and what does it all mean?
Well, the TLT, it's interesting because it's really sensitive to changes in, well, both economic growth and the inflation expectations. There's this idea out there that if stagflation hits, the TLT will just plummet.
Yeah.
But, it's more nuanced than that. You got to consider different scenarios. For example, like what happens if growth slows to, say, 0.5%, but inflation stays really high, like 4%?
I'm guessing that wouldn't be a good thing.
Well, it could actually lead to long-term yields kind of stabilizing around, say, 4.5%, which might keep the TLT relatively flat, actually. But the bigger question is, how likely is stagflation in the first place?
That I call us the question, isn't it? I've seen so many headlines about it, but are we really headed for like a 70s rerun?
Well, it's definitely a possibility, but it's not I'd say not the most likely scenario. Typically, when economic growth slows down, inflation tends to cool off too. Now, the exception is, well, when there were some major supply side disruptions like we saw, during the pandemic, that's when you get that nasty combination of stagnant growth and rising prices.
So unless we get hit with another round of that supply chain chaos stagflation, it might be more of a boogeyman than a real threat then.
Yeah, it's definitely something to monitor, I would say, but I wouldn't lose sleep over it just yet.
Okay, good to know. Let's talk about something a little closer to home. Walmart. Their earnings report just beat expectations. But I'm actually more interested in like what they're seeing on the ground, what really caught your eye.
Yeah, well, for me, the big headline was that Walmart beat expectations. But, when you kind of dig into the details, it's the behavior of those higher income shoppers, those making over $100,000, that is really interesting. They seem to be shifting to more what they call value-oriented spending. And that seems like a pretty significant trend, don't you think?
It really does. It suggests that even those higher earners, they're feeling the pinch of inflation or maybe like bracing themselves for it, and it lines up with that data from the New York Fed that shows that rise in both mortgage A&D auto loans. People are taking on more debt, maybe because they just, well, need to stretch their budgets further.
Yeah, exactly.
But here's where it gets a little confusing for me. Walmart also said that they're seeing like minimal inflation, even deflation in some categories. How does that square with, this whole picture of rising prices everywhere else? Are they just trying to downplay inflation?
That's a great question, and it really highlights the importance of looking beyond just the headlines. Walmart's data, It might not be capturing the full picture. They're seeing some price drops in general merchandise.
Yeah.
But other areas like car prices and insurance and rent, things that aren't really reflected in Walmart's data, well, they're still experiencing some significant inflation.
So it's not as simple as just looking at like one company's data. We
Uh-huh.
need to really consider the whole picture.
Exactly.
And speaking of the whole picture, we can't ignore those rising delinquency rates. The New York Fed's data there, it was a bit concerning,
Yeah.
right? The
Okay.
delinquency rates on credit cards and auto loans are creeping up. And while they're still below those pre-pandemic levels, it's not exactly a comforting trend.
Especially when you consider that, well, short-term mortgage delinquencies are actually already back to pre-pandemic levels.
Right.
And once those student loan payments start back up again, well, we could see another whole wave of delinquencies on top of that.
So we've got these like mixed signals, right? We've got this seemingly strong earnings beat from Walmart, but we're also seeing these signs of rising debt and delinquencies. It paints a much more complex picture of consumer health than like a simple earnings beat headline suggests, right?
Absolutely. And this is where it gets really interesting, I think, because now we have to kind of connect this back to the stock market. If consumer spending really is weakening, are there certain sectors that might be like more insulated from a downturn, places where people will just keep spending no matter what?
That's the million-dollar question. I'm really curious to hear your thoughts on that.
Well, if we're thinking about sectors that are, less reliant on what we call discretionary spending, healthcare immediately comes to mind. People need medical care no matter what the economy's doing. And consumer staples, those essential goods like food and household products, they tend to see pretty stable demand even during economic slowdowns.
Right. Those are things people need, not just things they want. Makes sense. But what about those want categories? Is there anything there that might still hold up?
Yeah, potentially. We can see some resilience in areas that are tapping into those longer term trends, like renewable energy and infrastructure. These projects, they often have, government backing, which can help kind of buffer them against any economic volatility. And within tech, there are segments that are less reliant on consumer spending and could actually even benefit from a shift in the economic landscape.
Okay, so even if things get a bit rocky, there are still potential opportunities out there. It just comes back to understanding those underlying trends, right? And being selective about where you invest your money.
Exactly. It's all about managing risk.
Yeah.
I mean, nobody can predict the future perfectly, but, by understanding these broader dynamics, well, you can make those more informed decisions and, potentially position yourself for success.
Speaking of making informed decisions, everyone's eagerly awaiting NVIDIA's earnings report. Their growth has been phenomenal. I mean, over 800% since ChatGPT launched. Expectations are sky high for this report.
Absolutely. Analysts are projecting revenue of $33 billion. That would be an 82% jump from last year. And earnings per share, well, those are expected to soar by 88%.
Hmm.
Those are serious numbers. Investors are going to be scrutinizing every detail.
So what should we be watching for specifically in this report? What are the key things that'll tell us whether this growth is sustainable or not?
Well, first and foremost, got to see if they meet those really lofty financial expectations. Are they hitting their revenue and earnings targets? But beyond just the numbers themselves, we need to pay attention to their forward guidance. What are their expectations for future demand? Are they seeing continued strength in orders? Are they anticipating any supply chain challenges? Their outlook, that's going to be crucial in figuring out whether this AI-fueled growth can continue.
Right. Because, I mean, if they signal that the good times are over, that could send shockwaves through that entire tech sector.
Exactly. Their guidance, well, everyone will be watching that very closely. Investors, analysts, everyone. A strong outlook from NVIDIA, that could boost confidence in the broader tech sector and kind of signal that this whole AI boom, it's far from over.
Yeah.
But if they paint a more cautious picture, it could raise some concerns about a slowdown in tech spending.
So we've got some potential opportunities in tech if NVIDIA delivers. And we've got those defensive plays in sectors like healthcare and utilities if consumer spending weakens. It's a lot to take in for sure.
It is, but that's what makes this so fascinating, right? We're connecting the dots between all these seemingly, these disparate pieces of information and trying to use them to make sense of this whole market. And ultimately, that's what helps you make those more informed decisions.
Okay, let's take a quick breather and then dive back in. We've covered a lot of ground, that's for sure. We started with that market snapshot, then explored Bitcoin's wild ride, the specter of stagflation, and those kind of mixed signals from Walmart and the New York Fed data. But there's still more to explore.
Absolutely. We need to dig a little deeper into those potential opportunities and risks across all those different sectors. And maybe even tackle the big question. What does all of this mean for you and your own personal investment strategy?
All right, so we talked about some potential bright spots, healthcare, consumer staples, maybe even renewable energy and infrastructure. But let's be honest, a lot of people are wondering about tech. It's been such a powerhouse for so long. Can it really handle a slowdown in consumer spending?
Yeah, that's a great question. And I think the key here is, nuance. Tech isn't just this one big thing. There are parts of the sector that are much less reliant on consumers just opening their wallets, and some might even benefit from, like, a shifting economic landscape.
Okay, so it's not just a blanket buy or sell on tech then. What are some of those like less consumer dependent areas that we should be thinking about?
We'll think about things like enterprise software,
Sure.
cloud computing, cybersecurity. These are all essential services for businesses. And that demand, well, that's likely to remain pretty strong even if consumer spending takes a hit. In fact, if companies are looking to cut costs, they might actually double down on things like, automation and data analytics, which could actually benefit those sectors.
That makes a lot of sense. Businesses still need to operate and protect their data regardless of what's happening with, the average consumer out there. It's almost like a counter-cyclical play within tech.
Exactly. And,
Yeah.
and let's not forget about this ongoing digital transformation that's happening across almost every industry. That trend, well, it's only accelerating, which is creating more opportunities for those tech companies that provide the infrastructure and the tools for this shift. Think about healthcare, moving to the cloud, manufacturing, adopting AI-powered robotics, even, those traditional retailers building out their e-commerce platforms. That's all driven by tech, and that demand, that's not going away anytime soon.
So there's a lot more to the tech story than just, the latest gadget or social media app. It's about the underlying infrastructure and the services that are really powering this whole modern economy.
Precisely. And
Ah,
and that's why it's so important to look beyond just the headlines, right?
ah.
And really try to understand those specific subsectors and
Mm.
what's driving their growth. It's not just about tech as a whole. It's about understanding the nuances within the sector.
Now, I want to circle back to something you mentioned earlier about NVIDIA's forward guidance and why that's so important. Can you break that down a bit more for us?
Sure. So NVIDIA, they're right at the forefront of this whole AI revolution. Their chips are powering everything from self-driving cars, to drug discovery, to those amazing large language models that everyone's talking about. Their growth has been explosive. So everyone is really waiting to see if they can keep up this momentum.
Yeah, 800% growth since ChatGPT launched is, well, that's pretty mind-blowing. What are some specific things that we should be listening for when they release their guidance?
Well, first and foremost, pay close attention to their language. Are they optimistic about the future? Do they see continued strong demand? Are they talking about expanding into new markets or applications?
Yeah.
Or are they starting to sound, a bit more cautious? Are they mentioning any headwinds they're seeing in certain sectors or geographies?
So it's not just about the numbers themselves, it's about reading between the lines and trying to gauge their overall sentiment about the future.
Exactly. And,
Yeah.
and it's also important to remember that forward guidance, well, it's not a guarantee. It's just their best guess about what the future holds. And things can change quickly, especially in a fast-moving industry like tech. But it does give us some valuable insights into what they're seeing and how they're thinking about the future.
All right, so we've got some potential opportunities in tech if NVIDIA delivers, and we've identified some defensive plays in sectors like healthcare and utilities if consumer spending weakens. It's almost like we're building a portfolio in real time here.
That's a great way to think about it. It's all about connecting the dots between, these seemingly disparate pieces of information
Yeah.
and using them to inform your own investment decisions.
Yeah.
And it's important to remember that everyone's situation is different. What works for one person might not work for another.
That's a really good point. There's no one-size-fits-all approach to investing. It's about understanding your own goals, risk tolerance, and your time horizon.
Absolutely. And it's about staying informed and being adaptable,
Right.
right? The market's constantly changing, so you need to be ready to adjust your strategy as new information comes out.
Yeah.
But that's what makes it so interesting, right? There's always something new to learn and explore.
Speaking of learning and exploring, let's dive back into some of those sectors we touched on earlier. I want to get like a bit deeper into those potential opportunities. We talked about healthcare and consumer staples, but what about something like utilities? They don't always get a lot of love, but they seem pretty resilient, right?
Yeah, utilities are definitely interesting from a defensive standpoint. People need to heat their homes and turn on the lights no matter what's happening in the economy. And they often have these regulated monopolies in their service areas,
Yeah.
which can provide some stable and predictable earnings.
So they might not be the most exciting investments, but they can offer some stability and some income, especially when times are a bit uncertain. What about something a bit more on the growth side, like renewable energy? That seems like it has a lot of potential.
Yeah, renewable energy is definitely a long-term growth trend driven by both, environmental concerns and government policies.
Mm.
And we're seeing massive investments in this sector, from, solar and wind farms to battery technology and smart grids.
So there's the potential for both growth and impact in that space. What about infrastructure? That seems like it would benefit from all this talk about, government spending.
You're right. Infrastructure projects, things like roads, bridges, airports, even broadband networks, they tend to be less sensitive to those economic cycles because they're often, well, government funded. And there's a huge backlog of infrastructure needs in many countries, so we could see some significant investment in this area for years to come.
Okay, so we've got like a range of potential opportunities here, from those defensive plays in sectors like utilities and consumer staples to those growth opportunities in areas like renewable energy and infrastructure. And of course, we can't forget about tech, which, well, it always has that potential for innovation and disruption.
Exactly. The key is to do your research, understand the risks and the opportunities, and build a portfolio that aligns with your own individual goals and risk tolerance.
Okay, so I'm trying to get my head around all of this. Feels like we're looking at a market where some sectors, they might be slowing down while others, they're ready to take off. Sounds like a seesaw. Gotta pick the right side to be on.
Yeah, that's a great analogy. It really kind of highlights how important it is to understand all those forces at play. We talked about some potential headwinds, for consumer spending, but there are some tailwinds too pushing certain sectors forward. Think about all those trends we discussed. Digital transformation, the shift into renewable energy, the need for some modern infrastructure. Those are all powerful forces that'll keep shaping, that investment landscape.
So even if things, get a little bumpy in the short term, there are still those long-term trends that investors can, well, capitalize on. It's about having that broader perspective, I guess.
Exactly. It's kind of like, being a ship captain. Got to be aware of those immediate weather conditions, but you also have to know, where you're going, your destination, and chart a course that takes into account, the prevailing winds and currents.
Okay, so we've got our map and compass, but what about the crew? How do individual investors fit into all of this? What role do they play in navigating these complex waters?
That's where it gets really interesting, I think. In the past, investing, it was often seen as something, well, only for the wealthy or for those, professionals. But today, I mean, anyone with an internet connection can access information and participate in the markets. And that's incredibly empowering, don't you think?
It's almost like democratizing finance, giving everyone a chance to build wealth and reach their goals.
Precisely. But with that access comes responsibility. It's more important than ever for individuals to really educate themselves, understand the risks out there, and make those informed decisions. That's why I'm so passionate about what we do here, providing people with that knowledge and those insights they need to navigate this whole complex landscape.
And it's not just about like picking the right stocks or timing the market perfectly. It's about having, a sound investment philosophy, understanding what your goals are, and being able to weather those inevitable storms that come along the way.
Couldn't have said it better myself. It's about having that long-term vision and not getting swayed by, all those short-term fluctuations, and recognizing that investing, well, it's not a get-rich-quick scheme, right? It's a process. It takes patience, discipline, and a willingness to learn and adapt.
This has been a truly eye-opening deep dive. We've covered so much ground, from those latest market trends and the, well, Bitcoin frenzy to that potential impact of stagflation and those mixed signals on consumer health. And we even explored some potential investment opportunities across all those different sectors.
And I think the key takeaway here is this. The market's always evolving, and there's always something new to learn. But by staying informed, being adaptable, and focusing on the long term, you can position yourself to really navigate those challenges and seize the opportunities that lie ahead.
So what's that one piece of advice you'd give to our listener who's, just starting out on their investing journey? What's the most important thing they need to know?
I'd say this. Don't be afraid to ask questions. I mean, there's no such thing as a stupid question, right?
Okay.
And the more you ask, well, the more you learn. And don't be afraid to make mistakes. Everyone does, especially when they're first starting out. The key is to learn from those mistakes and keep moving forward.
That's great advice. And remember, I mean, there are resources available to help you along the way. You've got books, podcasts, websites, even financial advisors who can give you some guidance and support. The important thing is to, well, to just take that first step and start investing in your future.
Absolutely. The journey of 1,000 miles. It begins with a single step.
Well said. This has been a truly enlightening deep dive, and I think, well, we've given our listener a lot to ponder. Thanks for joining me.
It's been my pleasure. Always a great conversation. And remember, I mean, the future is what we make it. And by making informed decisions, well, we can really shape our own financial destinies.
Oh, that's an empowering thought. Thanks for joining us on this deep dive, and we'll catch you next time.